Delighted that you've joined us this afternoon. We at Wilkerson have been working with closely held businesses and their owners and with high net individuals for all of our 90-year history. We put on a seminar like this in order to be educational, but as I mentioned a minute ago, not to take the place of professional consulting. Hopefully you walk away today with some things to think about and some things to consider and things that we will be happy to discuss with you, or that you can talk with another professional to make sure that you get sound advice as you move forward. We really like working with folks just like you. We would be happy to work with others that you know who are just like you. We have a table over here with some brochures that tell a little bit more about us, so we'd be happy for you to take some of those away and give them to your friends. But right now, we're going to go ahead and go into the second part of our program. Our guest speaker this afternoon is Mary Doherty. Mary is a CFA, Certified Financial Analyst. She's a PhD. She is the Associate Professor of Finance at the University of St. Thomas. She's very actively involved in teaching, in research, and in consulting. She teaches courses at the undergraduate, graduate, and executive level in corporate finance, investments, and I would say especially in family business. She actually is also the faculty director for the Aristotle Fund, which is a student-managed portfolio which directly manages approximately $5 million of the University of St. Thomas endowment. She also has some other background in terms of her own involvement in the world of business, and I'm going to let her tell you about that to give you that perspective. She has told us that she very much likes a dialogue, so she's going to be speaking for a short time, and then she's going to open it up for questions, and she welcomes your questions. So hopefully we'll get a good, healthy dialogue going. Please join me in welcoming Mary Doherty.
Good afternoon, everyone. I am thrilled to be here, and particularly after listening to all that doom and gloom. We're not going to end this session on doom and gloom. I actually think there's some amazing opportunities out there, and I want to address that. But we are going to start with a little gloom and doom. So bear with me. I want to give you a context of who I am and why I'm here so that you understand where I'm coming from. So I started my career down the road at First Trust. Quaint little place that it was back then, turned into First Asset Management, various renditions, U.S. Bank, Nuveen, and now it's owned by one of those terrible little alternative investment things we just talked about, private equity. So I escaped there, went over to the university. While I've been at the university, I started there, well, I barely remember the first 5 years because I was getting my PhD and having 4 children, but once I got that done with, I started working with do-it-yourselfers because at the time, there was a big shift that you probably all remember from defined benefit plans to defined contribution plans. So having been an expert and having my CFA and liking markets, I worked with do-it-yourselfers on how they would invest. And I did that because I needed to be current in the classroom, right? Otherwise, I had no value add. So I did that. And then, actually, I started to work with, well, at the same time, my family owns a business, and I started to work with my family members, and I had my own little laboratory. And so I got to work a lot on how does a family business professionalize not just the family, which is a challenge in and of itself, but the business, and have it continue to grow. So while I did that, a lot of my do-it-yourselfers also happen to own businesses, and when I talked to them about the public markets, we'd get into the private markets, and ultimately I ended up doing consulting. I moved away from just working with individuals and working a lot with businesses, and my whole goal of my whole career is how to help businesses add value. And I do that with a little bit of my finance background, of course, and a lot of hands-on experience. So that's what I was doing. I moved from consulting, and I also serve on some boards, and I happened to meet the people from Wilkerson at a panel a couple of months ago that I participated in on smart growth, and particularly how smart growth can be done in a small business or in a private business, not necessarily small. And so that's how I got to be where I am here today, and I thought it was important for you to understand the context. Because I am an academic, but not really. I'm a practitioner, and that's where I come from. Indeed, my very first actual academic research was on the whole ethical situation revolving around defined benefit versus defined contribution, and really can we expect people to manage their own money. So, and I've moved a long way since then, but so that's where I come from. So why is that important? Is because I want to talk about 3 different topics here, and I'm going to look at them from my own lens, which is varied. Okay, so we'll start with, I'll talk about we've heard about increasing regulation. We have been living it for quite a few years, but what I see as the impact of that, particularly at the board level and in the private business. I can't help but talk about Minnesota tax hikes. But again, I'm going to just build on what was said earlier, so I'm glad I was here. But ultimately, I am hoping that we're all going to leave really excited about the world we live in, because we are in the middle of a technology revolution, and I am convinced that that's what's going to lead us out of our problems today. So, the first thing, regulation. Here's the deal. The problem with regulation is it's caused investors like myself that actually invest in a lot of public companies to have fewer companies to invest in. So what I did is I pulled out different articles. I read a lot. I love to read. And this happened to be an article out of USA Today. And it says, investors face a shrinking stock supply. Fewer private companies decide to go public. So what this is showing us is that, frankly, the amount of IPOs has dropped significantly, and the idea is that we're back in the late 90s, early 2000s. Mind you, we were in what Roger perhaps identified correctly as kind of a bubble. It happened to be the internet bubble that we first started with. And so we had a lot of IPOs, but unfortunately, we came out of a recession. I do not believe we're in a depression. And I believe we're out of the recession, but we came out of it and we aren't getting as many IPOs as I would like to see. So there's fewer available public market opportunities. This shows it in a different way. This shows us actually stocks that are out there. So initial public offerings are companies that are deciding to go public. This actually shows us companies that were public, and a lot of public companies are no longer standalone entities. So, just to bring in some of my own research, a colleague and I did research on family-controlled businesses that went public, and we purposely did our study based on companies prior to Sarbanes-Oxley, and then we tracked those companies through after Sarbanes-Oxley. And the sad fact is 20% of our companies went private again. So not only did they choose to go public thinking that was the way to go, but after Sarbanes-Oxley, we can't, as in all research, you can't definitively say that was the reason why, but it was truly amazing that we lost 20% of our sample size, and they all went private. There was another 45%, and that 45% got bought out. And so they had gone public, needing to raise capital. They wanted to stay family-controlled, which you can do in the public markets. But they ultimately decided, for whatever reason, serendipitous perhaps that it was through regulation, they decided it wasn't worth it. And they went ahead and they got bought out. So there's a lot of what we call M&A, merger and acquisition activity. And it's happening and we see it here. So the amount of publicly held companies that we can choose from is less. So whether we like it or not, we're stuck investing in the alternative investment arena if there's fewer companies out there that are available. So as I alluded to, there's a lot more interest in companies in staying private. The reality is staying private avoids SEC regulation. Compliance is incredibly time-consuming, and probably more important from a private business perspective, going public, it's costly. And they're not used to giving out all that kind of information, so it's a huge cultural change as well. So why are private companies important anyway? Well, that's the part that's absolutely amazing to me, is I found that I could do a lot more with private businesses because there's so many of them. So private companies account for up to 70% of GDP and 80% of new jobs. And that, in and of itself, is why we should care about private companies. But even companies that don't operate in a vacuum, they can't operate in a vacuum. They're stuck dealing with these economic policies, and particularly the legislation that impacts them all. So, as we know, the federal government has been busy impacting various legislation, and unfortunately, so is Minnesota. This is a sad, sad state of affairs. When I opened up the Wall Street Journal in October, and the headline was U.S. states that you should not be caught dead in. And the subtitle of this one, I don't have it up here, was probably scarier to me as a resident of Minnesota. Minnesota has increased the incentive to move to Florida. I think we all know that. So you heard the details this afternoon of all the taxes. What I'd like to point out here is, again, this is just right out of the Wall Street Journal, and shows that we are sitting there now at a rate that's extremely high, and we are, I believe, the fourth highest tax. Matter of fact, I have it there. Yeah, the fourth highest income tax rate in the nation. So this particular slide is dealing with the article that I opened up and read out of the Trib, and it said, it was back in May, and maybe early June, and it was Dayton scolds business leaders for opposition to tax overhaul. So Governor Dayton presented at the Chamber of Commerce, and he had a speech there where he basically used the statistics where he's quoted in the paper as saying that Minnesota dropped from the 8th highest in state and local taxes in 1996 to the 15th highest in 2010. But what he had failed to recognize is that his new tax implications was going to make us be, now we're back up, we're at the 4th. So we're the 4th highest state in the nation for income tax. In his defense, what Dayton believes is that low state taxes result in lower job growth and lower per capita income. So he used some statistics to prove his point there. I don't have any intention of this being a political debate here. I'm just telling you what he said, and I am going to reply with what was in the paper the following week. It happened to be written by my colleague, John Spry. He's an economist. He's in the finance department at St. Thomas. I did not collaborate with him on this article. But what he said, and I don't have it up here, is don't cherry pick when the costs are weigh the costs and benefits of higher taxes. But where the academic piece of this comes in is what he brought out is that the most peer-reviewed economic research examining the aggregate effect of state taxes actually says that there's a negative relationship between taxation and growth. So the jury is out, I guess I will say, on where we stand on that. But what that does is it leads us to what I consider the most important question, and that is, do people change their behavior based on taxes? I would say that's the $1 billion question that Governor Dayton has right now. What he had suggested is that, you could read it there, he thinks that his budget would bring in $1.8 billion in new tax revenue, and the Chamber, of course, disagreed with that. The reality is that it's kind of going to be a wait and see here. So, again, the Wall Street Journal thinks so. They think that Minnesota has now given us an incentive to move to Florida. But we really have to evaluate, will people move? I do want to reference what Bob said earlier, and it was that last week the tax revenues for the state of Minnesota were announced. And Governor Dayton, absolutely, front page of the St. Paul paper, said, and in big letters, he is going to cut the business taxes. Now, mind you, it's those three taxes that were mentioned earlier. But unfortunately for him, they also in the same article interviewed the state the leader of the House, and the leader of the House said, not so fast. We have a lot of spending programs that we need to do. So I don't know how that will all pan out. So if people move, we're going to see that because we're going to feel it in the fact that that $1 billion increase in revenue won't be seen. At the same time, there's a couple of things that people can do besides moving. And the one that I didn't hear mentioned today, and I don't know how relevant it is for my audience, but I do know personally it's private business owners that own their corporations as S corporations. And I am absolutely certain that there's some of those that are going to convert to a C. And in and of itself, that does not sound appealing, but because they're private businesses, they know that they have what we call, accountants call, I won't consider myself an accountant, AAA, but it's an accumulated asset basically that has been, tax has been paid on already. So what's happening is some of these companies are, the shareholders are giving a note to the company, and they're going to be paid back to spend down, in essence, the note through the AAA for distributions over the next 5 to 10 years. One of the companies I know, I don't know when they run out of it. And what that will do is definitely cause tax revenue to go down for the state if any of those big companies, and they don't even have to be particularly big, but high-income companies choose to do that, because then they'll lose the income that they were getting before. That's a complicated venture. I'm willing to take any questions on that or discuss that offline, so to speak. So that's something that we need to consider. But skip all that. That is all gloom and doom. What we really want to talk about is what's going to get us out of this mess. And I think what's going to get us out of this mess is something that we are living in, and I think it's as big as the Industrial Revolution, the buildup after World War II, and it is the technology revolution. And we're not talking the dot-coms of the 1999 to 2001 period. We're talking about major change in how businesses look at adding value to their companies long-term. So we're really talking about smart growth here. I want to point out this first quote because I was at the National Association of Corporate Directors meeting in October. There were 2,000 people in that room. From all sorts of companies, very large publicly held company. I met a director from ExxonMobil there. They were all there, and it was an amazing conference. This woman, Clara, she is CEO of Hearsay Social. She's on the board of directors for Starbucks. She was the chief investment officer at Google, and she is 31 years old. And as she spoke, you could have heard a pin drop in the room. Because she was saying this, and everybody in the room was saying, I was doing the same thinking, oh my God, these 3 companies I'm on the board of, we've got to be ready. We have to figure out what we're going to do here. Because in essence, her message was, all of you in the room, your companies need to be technology companies. Otherwise, the technology companies are going to come in and basically eat your lunch. And then it followed up with, I was reading, of course, Wall Street Journal is my favorite paper. So I was reading the Wall Street Journal, but a couple of weeks later, and sure enough, this Neil Ash, who's the CEO of Walmart's global operations, he's located in Silicon Valley. And his quote, "We are not a retailer in Silicon Valley. We are building an internet technology company inside the largest retailer." Target's doing the same. These companies have got to do it. But so do we, for our own companies. Okay? I'm sitting there on the board of my family's business and on Mars and Power. It's an investment firm. And a small construction supply company. All 3 of these boards, I have absolutely pounded the table. We have got to figure this out. And some of that is well beyond what we can do in this room. We have to get the younger people that understand the technology. I would be the last person to think that I own technology, but to understand what it can do. But here's some of the things it can do that I know are amazing. First of all, perhaps some of you saw the picture of the drone that the CEO of Amazon, Jeff Bezos, was talking about. Well, my texts were hopping that day because I've been talking about drones and how this is going to work in the distribution business, and none of these guys on the board believe me. Now, it's a ways off, but I was vindicated. I do believe that that's going to change a lot about delivery of product. Cars. They already know. Cars already exist that drive for us. But they can't introduce it yet, right? They got to get the public to want to do this. Those cars are going to drive for us, and then what we're going to do is be more productive. That's the risk. Technology makes you more productive. You miss your chance to zone out in the car and way home from work or whatever it is. So, but the productivity enhancements. So that's kind of the fun stuff. But what's really going to change is healthcare and delivery of healthcare and the way we measure healthcare. And there's so many amazing opportunities that are going to happen there. Imagine a situation where you have a chronic illness, or you don't even know if you do, but you have a hereditary risk. They're going to implant devices in us. Oh yes, they will. And we're going to want that because it's going to track so that they get information and they know what's going on and what the medication is that we need to take. Not only that, we'll be able to help countries that are much poorer than ours where they don't have the adequate health care by finding out, by big data. Big data is huge. I mean, the best major for your grandchildren or children to have in college is definitely applied mathematics or statistics. These people are going to go through, they're going to be rummaged through this amount of data because you need to be able to understand it, and they're going to be able to identify epidemics before we even know they exist. Nowadays, you have to go and get all this, but they're going to be tracking this. So I truly believe that that is what's going on here, and the opportunities that that's going to give. Notice I said opportunities, not threats. The opportunities that that's going to give for all of us is what we need to embrace and encourage. And that's why that 2,000 people in that room, after she stopped speaking, we all started speaking. And things that we can do and how we can take advantage of the opportunity that's there for us. If you don't believe me, just in case, I had to pull out a couple of more things from the newspaper. Twitter. So it is the case that there are fewer IPOs. It's also more difficult to participate in those, except for now, we have this whole idea. I think there's going to be more microfinancing. Twitter is an example of that. The company sold a lot of their stock off of the traditional route that you go to issue stock. So did Facebook. But small entities, small entrepreneurs, of which I know many, they can raise money this way now. And that's going to help. So those banks aren't going to be hoarding all that cash because they're going to have competition from a lot of people that are going to want to invest to Roger's point again. So that's one thing. But then the scarier thing is I'm used to getting the brightest and best walking through my classrooms. But gosh darn it, now they're going into applied mathematics. You know, that's not to say I have great, don't get me wrong, I have great students that are being wonderful employees. But what we're finding is, and this again was right out of the Wall Street Journal, that was the headline, elite grads in business flock to tech. It is no longer Wall Street where everybody wants to go. And that is true for my students as well. They're seeing the opportunities in the technology revolution to go into everyday companies that are doing everyday products and coming up with ways to make a difference, to add value. And I have the best job in the world because I get to be around these people. And that is why I absolutely believe you should not leave this room at all Debbie Downer, but really up, because and our culture, our American capitalistic culture encourages that. So on that happy note, I will open it up to questions.
Barry, you got hands popping up back here. We'll start here in the middle.
Good evening. The question is on the Twitter IPO for $25 billion, and they don't produce any money. I mean, how do they?
No earnings.
No earnings. There's nothing. How in the world is it worth $25 billion?
I didn't say I agree with the value, but I do. That does remind me of something I wanted to say from an earlier comment about are we at the top now versus in 2000? And we're not, because the asset base, the balance sheets are stronger, the cash flow generation is strong. But getting back to your question on Twitter, the difference is it's one of the new ones, but the amount of information that they disseminate, that information is so incredibly valuable that the businesses that are going to come out of that, I think in the end is what's going to make it worthwhile. And they're definitely working on a revenue model that's going to work, and there's clearly investors that are interested in it. I am not particularly interested in investing in the public markets in technology companies. I am looking myself personally for companies that have an opportunity to use technology to add value, because I believe they're going to do it.
There's something fundamental that I do not understand about these projections. And that is that short of handing out condoms and contraceptives on street corners, we are going to continue to have a large number of people in our society who never get this kind of education to qualify for these kinds of jobs. I heard the other day that Applebee's is going to have terminals on their tabletops so that people can make their orders there. That eliminates many of the jobs that are currently, I mean, where are the people going to work that do not fall into this high education category? I don't get this.
I will tell you that I happen to know a lot of teenagers and young adults that live in houses that were on welfare. They all own smartphones. They all know the technology. And I'm telling you, I think the industry that's most at risk is the one that I work in. So thankfully I have other jobs, because I think higher education is completely changing, and it should. Okay, tenure, gone, it's ridiculous. We need to have an opportunity for people to get an education that is basically free. And we have that. We have all these schools that are offering that on the internet. I don't even try to compete with some of the amazing YouTube videos on the basics of finance. Why would I? It's much more, I get a kick out of them. I send my students to them, we watch them, I have them watch them for homework, and then when they come in the classroom, we talk about how do we apply this. That's the part that's going to be hard to transmit on the internet. But I think, actually, to your point, it's an opportunity. The technology of the information flow is what's going to make the difference, and that's going to get a lot of people out of poverty. Great minds don't think alike.
There are people who, I guess I'm not talking about the teenagers that are just getting out of high school now, and those in their early 20s.
Mm-hmm.
I'm talking about the people who already have responsibilities in their mid-20s and up, who are working 2 and 3 minimum wage jobs. They don't have the energy to be coming home and getting a degree online.
I agree with you. It's not for everyone, but you would be amazed. Go visit St. Kate's. We do an amazing job with these young women and helping them get through while they have full-time jobs and children. It takes many different mechanisms. That's absolutely true. But I think the opportunities are way more.
The question over here.
What do you think about the education online, and is that a partial solution for these people that she just mentioned?
I absolutely believe in education online. I do a vast amount of my teaching with my students online. They come to class, but I have them using all the different resources. I have former students that are now getting graduate degrees on this online system, and they'll come to me to proctor their exam. Because it has to be proctored by a PhD. There is an amazing opportunity in third world countries for this to happen. And even to get over the language barrier. Because if you want to learn Spanish, French, download, you'd be amazed what you can pick up. But I think that is the best opportunity. Yes.
How do you think this will impact the income disparity? I heard the other day that 5 members of the Walton family have more money than 40% of Americans.
I hope that because it opens up doors for education, that the disparity will be different. I think microfinancing is going to put a few private equity firms on their reviewing their pay structure. I agree, the pay structure for some of the alternative investments, and even some of the publicly managed mutual funds up there is atrocious. Not my fabulous Mars and Power down the street, by the way. They're an excellent low-cost mutual fund company. But it is, if they have some success, they can charge that. So I can only hope that through education and competition. But that's a problem, and I have no quick fix for how we can deal with that, and it's just gotten worse over the last decade.
I'm just wondering if, there's such an emphasis on technology, do you see a diminishment of sort of the humanitarian side of education?
No, and the reason for that is because of this whole idea, I don't know if you've read anything about it, but conscious capitalism. Most of the young entrepreneurs that I invest in happen to be students at St. Thomas. We have an incubator. We have a fabulous school of entrepreneurship and was supported by Richard Schultz. And we have students that they have great ideas. We incubate them. We give them the space to work. And they raise capital through angel investors. And my most recent investment was with a company where he is actually, he is embracing this whole idea. He's trying to build up a way to increase the visibility of sports that don't get the attention of the amateur athletes that are at that level that go to the Olympics, et cetera, or hope to. And he's selling trail mix, but he's putting their pictures on there, and he's giving back to that sport, and he's getting teams that are participating in it, and he's actually making a little money. But there's so many like that, and they want to make a difference, and as infuriating as it is to sit there with my own students and children as they're talking to each other by not speaking and they're all texting when they're in the same room, you all know what I'm talking about. They feel a connection in a way that is baffling to me, and they're willing to trust and build. So I think this whole idea of conscious capitalism is really catching hold with that generation. I think it's going to be a much less traditional way than how we give, but I do think it's going to be there. It's different. It's all also technology driven.
Can technology figure out what to do with the national debt?
It is so infuriating. No, but that's why I said I think the productivity enhancements would generate more growth, and I believe that long-term strong economic growth obviously is going to generate the income that's needed to pay off the national debt. If we don't tax the heck out of people in the province.
Can you address your market outlook for the next 1 to 5 years?
With all kinds of caveats, Mary.
Right. I can personally, but because I'm on the board of Mars and Power, I don't know that I really should speak to that in this venue. How's that for a
That's good.
clouded answer?
That's very good. Oh, Jeff, another question?
I'm optimistic. I don't think the market's overvalued.
I have a question. Wisconsin and Minnesota legislatures have taken vastly different tracks in how they're approaching it. Can you comment on what the pluses and minuses and what the differences are between the two states in terms of the results they may find with those two different tracks?
Right now I have a cabin in Wisconsin, and my husband and I think we should move there. So that's a stimulus right there, right? But because we could still keep our jobs and go off to our cabin and we get taxed less. That is kind of the simple answer to a very complicated question. I don't think Wisconsin doesn't have the strength of resources that we do. So at the end of the day, I just don't think we have, because we have Milwaukee, one could argue, is a major metropolitan area, but they have a more disparity in income in Wisconsin than we do here. So I'm hopeful for them that the lower tax rate stimulates that growth and keeps the spending going. In Minnesota, I think we're going to scale back the taxes. I just think that in the end, it cannot last. Dayton will be there for him, but it isn't him now apparently. So the legislature will give him a little trouble. We'll see.
Other questions?
What would you do with the surplus?
The surplus. Oh, our state surplus? Immediately, I would cut out the increased taxes and try to stem. I know personally too many people that are moving. There are attorneys that are making major bucks going out to the western suburbs and some of the northern suburbs, having free seminars on how to move out of Minnesota. That is going to hurt all of us. But I am sure there's people in this room that are ready. You might have already left. And I know so many people that are doing that. That's what I do with the surplus, because I think that's a great risk.
We had a question on income disparity, and I can't resist, so I'm going to jump in. Mary told me in an earlier conversation that she's a capitalist, and so am I, and neither one of us are ashamed of it. We have such a mythology out there. There was a fellow by the name of John D. Rockefeller who started a company called Standard Oil. And people look at John D. Rockefeller and said, oh, he makes so much money, and it was a monopoly and it was terrible. When John D. Rockefeller got into the oil business, the cost of a gallon of kerosene in this country was 50 cents a gallon. Several years later, after Standard Oil owned 90% of the market, the cost of kerosene in this country was between 7 and 8 cents a gallon. What that meant is that most people in rural America could now afford kerosene to light their homes in the evening, when before that, they could not. They had to light their homes by either a wood fire or very expensive candles. And the productivity in this country skyrocketed, even though Rockefeller had 90% of the oil market. And so, when we talk about income disparity, what do you think the income disparity was between John D. Rockefeller and the people on the farms? But the fact of the matter is, all boats were rising on those waters, and everybody was better off. And then on top of it, John D. Rockefeller gave about 90% of it away. So we have to be real careful when we hear these statistics about this horrible income disparity. The question is, where are people out there, and are their boats rising? Are they getting to higher levels of standard of living? And that's a far more valuable question than their comparison to a Bill Gates or the Walton family or anybody else. So be careful what you hear on the news. There's maybe another side to it as well. How's that, Mary? Is that fair?
Really good.
Does that work in your finance class? All right, excellent.
You could be my next guest speaker.
All right, I would be delighted to. Would you please join me in thanking Mary for her time with us this afternoon? Mary, I do thank you very much. Very stimulating conversation, some things to think about, and no doom and gloom at the end, so that's very, very good. Well, we are very glad that you all came to hear us today. We have one little thing to announce. Wilkerson, Guthmann, and Johnson has been in downtown St. Paul for 90 years. And after 90 years, we're actually moving out of downtown St. Paul. We are next Thursday and Friday relocating to Arden Hills, which is a suburb of St. Paul. We're still going to have our St. Paul identity, but we're going to be out in the suburbs. St. Paul is changing. It's changing very dramatically. And I'm not going to pass judgment on that one way or the other. It's just fact. And we're changing with it. So our new location is going to be at 1210 West County Road E out in Arden Hills.